Good morning, and welcome to the Real Estate Coffee Break,
the mini podcast that provides a quick download of information while you're waiting for that first cup of coffee to brew. I'm your host, Collin Clayback, and today our guest is Tim Hartwig of Treeline Multifamily Partners. Tim's career has spanned 20 years in both the Denver and the national real estate scene, and he has led asset management operations for both public and private firms. Tim, welcome to the coffee break.
Hey, Collin. Thanks for having me. Excited to be here.
Yeah, great. Well, thanks for being here. Your career, as I mentioned, has spanned several years, decades in Denver there, several asset classes of commercial real estate. But do you want to tell us a little bit about your current venture here with Treeline Multifamily?
Sure. Treeline's a private equity-backed group that is started about a year and a half ago. We're actively growing, actively in full-on acquisitions mode. We've got a little over 2,000 units right now, multifamily, kind of throughout the Southwest, with a heavy presence in the Colorado markets, and we'll more than double that again this year. Collin, we're focused primarily right now on multifamily, in particular, kind of newer product, Class A plus type of stuff that's generally all been built from 2018, 2019, 2020. We're backed by some private equity money. Quite a bit of it is internationally based, and it's one of those situations right now where we're very much focused on a long-term hold, looking at yield-driven investment matrix right now, not looking to hit home runs, looking for deals that are going to be stable for a long time, kicking off a fair return. We're very actively looking in like real estate in general, right? It's location. We're looking at a lot of sub-markets within Metro Denver, in particular, that are not quite downtown. We're seeing, like a lot of major metropolitan areas, I think, in the last year and a half with the COVID phenomenon, a bit of a flight from the CBD core of multifamily, although there's a lot of folks still building and developing. Some of our projects are right on that kind of next rung of the circle out from the CBD, and doing very well as folks look for still some of that urban feel, but not quite the downtown CBD high-rise type of feel. We're looking, we've bought several projects now that are pre-stabilized, meaning not fully leased up, coming right out of construction, probably midway, 50-60% leased, and we'll take it across the goal line ourselves we use third-party management teams as far as boots on the ground, but we feel we get paid a little bit for some of that risk, if you will. We're building a couple projects right now, small projects, but overall, when you look at the development risk, it's not quite our appetite or our equity partners' appetite, especially material costs. As we've all seen, lumber, steel, even the asphalt and granular components going into asphalt shingles, everything keeps going up really fast right now on that side. So, we're like I said, we're buying new, either pre-stabilized or just stabilized Class A product. A lot of our background of my partners and I is really on the value-added side of multifamily. Buying something 80s, 90 product and doing some type of rehab. But that market is just tough right now. It seems like the value-added piece, all the value is really priced into the sales price nowadays, and so there's not a lot of upside on the doing the work to take it from, say, that B to B plus or B plus to an A minus, whatever it might be. We're feeling kind of jammed on that side, so we're kind of going long term, slow, steady Eddie yield, cash on cash returns, and looking at other ways to add value and drive rents in markets like Denver. Because you're only going to go so far buying Class A product in places we play, Denver, the Denver market, Phoenix, Austin, San Antonio. Rent can only be driven so much. in even the hottest of markets, but trying to find other ways to drive value. We've got some solar projects going on right now, and with the new Biden team infrastructure plan, although I think it has yet to be kind of really ferreted out what that's going to truly look like as far as infrastructure for the multifamily world. We do know there are some additional solar incentives in there. We've been driving hard on utility efficiency type of things, water, faucets, heaters, toilets, getting better efficiency products in that front. And then, like a lot of multifamily, trying to figure out some of that holistic approach of the lease cycle for a resident. Where else might we be able to add on, tack on a service, make a fee, make an additional opportunity to drive a couple extra, economies there. Things like, the valet trash programs, pets, fees, pet deposits, pet services have become more and more prevalent in COVID as everybody's having, more and more pets, it seems. Trying to make sure we're smart. We're smart and we're maximizing parking. And there's different parking apps and things nowadays that we're using a lot to maximize the amount of spaces we have at a site, but making sure they're full all the time, and collecting some type of revenue on them.
We're hopefully going to try to, our team's going to try to do something for you on the renter's insurance front to create a revenue stream there as well.
Exactly right. Yeah, that's another part that, there's application fees and deposits and renter's insurance, as you say, that are all sort of, kind of piecemeal out there. And the more we can bring those into more, combined holistic picture, I think there's some economies of scale there we can all achieve.
Yeah, kind of a new playbook, stepping away from the value add playbook that has been really overdone in the Denver metro, I guess. I mean, I've known you for 5 years, 6 years now, and the Denver market, even in that short span, has changed so significantly. And I'm always impressed with your insight in the local market there.
It's a hot market too, as you mentioned. It's Denver's on everybody's radar. Every from the large institutions to smaller private firms, everybody's got the Denver deals on their deal list and their pipeline continually, and some of that has to do, of course, with the market itself, with jobs, and some of the great exodus, if you will, from the West Coast. The markets we're in, and certainly Denver and Austin and San Antonio, are all beneficiaries of that. But again, it's real estate 101 in a lot of ways, right, Collin? And
location, right?
Yeah.
No, I think you're right, and you see an exodus both in people and in tenants, and then in capital, right, which is making those deals more competitive. What other things do you think is giving you an edge, or that you guys are using to your advantage in this very tight and competitive marketplace and landscape?
Well, I think on the acquisition side, we've developed a bit of a reputation, on a great reputation on certainty of execution and certainty of close, which means maybe we're not going to be the number one bid all the time in a bidding process. Maybe we'll be the number two in terms of dollars, but we'll get it done and we'll close. And we move fast. We pride ourselves on the due diligence side of things and the very hands-on approach that we get inside every unit, every system, and make sure we understand it, so that by the time we close on an acquisition and it moves into more of the day-to-day operational asset management side of things, we know a project inside and out, and we know that rent roll inside and out. So working hand in hand with our third party daily operational folks, the property management companies, we're I think hands-on enough that in the markets we're in, that we're not I don't think we're a pest to our third party managers, but we're hands-on enough to really be able to pivot and drive. We're looking at for example, marketing and leasing, and how are you attracting residents, and we're pivoting in that and being flexible on that, monthly, not looking at it on a quarterly or an annual basis, how are we spending money, but whether it's kind of like pay per click or all the social media type of things, looking at what's the best avenue and what's driving traffic any single day, any single week, and changing that on the fly. And I think that is some of the paradigm that's got to happen more and more. The days of just drive-by traffic, putting up signs on the building and hoping people are going to come are long gone, of course. But it's more of a
hope is never a good strategy.
No, it's much more competitive on driving it and
Yeah.
finding your residents from a a social media type of standpoint and going after it, because that's the bulk of our residents are the young professionals. Happens to be more and more millennials by the day, of course, and they're a little bit of a fickle group as far as how and where they're getting their information. So moving and evolving with that has been certainly part of our MO as we go.
Sure. So we've come to close to the end of the time that we've got here for the coffee break today, but I did want to just kind of see where you think you guys are a steady Eddie. You're not looking for that quick home run or triple or double even, right? Just kind of get aboard and get these returns and get them steady.
Yeah.
Where's the next opportunity that you guys see? Obviously, you mentioned Denver is your backyard, and Phoenix and Austin. Are there any other markets or any other areas where you guys at Treeline are looking at?
Yeah, I think we'll move probably east as well as we look at cities like Nashville and Atlanta and others fit the bill for us pretty well. Also, as sort of Denver-esque in a way with the professional growth, job growth model that we're after, and then millennials on the Class A market. We're going to be interested to see on the development side how pricing, how interest rates and insurance rates and property tax rates move here as the whole society comes out of the pandemic more and more with the help of the vaccine and whatnot. We saw, I think you and I have chatted about, we saw right before the pandemic a tremendous, push for the last handful of years on more urbanized type of units, smaller units, getting more and more, heads per foot or heads per acre on developments. And then with everybody working from home, we saw the last year here, we saw, tremendous pressure on the larger type of units, larger size, 2 bedrooms, 3 bedrooms. Everybody wanted that den or office or little computer nook off the kitchen.
Yeah.
But we'll see how the market kind of pivots on that as people start to go back to work more.
That's really interesting. Obviously, some of those big urban cores, your San Francisco's, New York's, Chicago's, in Denver even, you saw some of these micro units, you saw some of these co-living units where people really want to be in the urban core and would take, much less square footage and pay a premium to do so. I'm wondering, I have not seen, but is there, there was this transition of big condos being converted to like co-living and micro units. Have you seen anything in Denver where things are being converted out of those to give more square footage yet, or is there any trend?
No, we haven't, but we're still only just slightly over a year into this thing, so I think the market will still kind of has to ferret that out a little bit, what it's going to do. But it'll be interesting to watch, and kind of a corollary to that as well is, like I mentioned, we see a lot more pets at apartment buildings. We see a lot more utility usage because folks are home all the time now. They're at home, they're working at home and living at home. And what is that going to mean as far as things like infrastructure related to internet and how we provide that? And then just the basics, of course, electricity and water and heat and things like that. But
great.
It's an opportunity to, again, our kind of goal is create value by smart operations and creating efficiencies of systems and people.
Well, I definitely think you're the man for the job at Treeline. You've been cornering the market on asset management for years now, and have really enjoyed the expertise that you bring to that field. So I know you guys are in good hands there. I enjoy working with you and appreciate you stopping by the coffee break here.
You bet. Thanks for having me, and I appreciate the opportunity and appreciate you, Collin, and all the Virtus team and everything they keep doing. And hopefully we're doing more and more business together here as we go, as we both continue to grow. It's been fun to watch your team's success here as well over the last number of years. Good job.
Well, thank you very much. I appreciate that, and appreciate you stopping by the coffee break. The coffee break is powered by Virtus Insurance, headquartered in Kansas City with offices across the country. The Virtus National Real Estate Practice insures over 350,000 multifamily units and 100 million square feet of traditional commercial real estate. Thank you very much for your time today, Tim.
Thanks, Collin. Appreciate it. Take care.